Well, good morning, everybody. I'd like to call this meeting of the FDIC Board to order. We have several items on the summary agenda this morning. Are there any questions or comments on the summary agenda? If none, may I have a motion to approve the summary agenda?
So moved.
Thank you. And a second?
Second.
Thank you. All in favor, please say aye.
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 The motion is adopted. We have three items on the discussion agenda this morning. The first is a memorandum and resolution relating to the proposed 2023 FDIC operating budget. Brett Edwards, Donna Saulnier, and Tom Petticord will present the case.
So good morning, Acting Chairman Gruberg and members of the board. We're here today to present for your consideration the 2023 budget and staffing authorization proposals. Specifically, we're requesting approval of an overall budget of $2.41 billion and authorized staffing of 6,310 positions. I will now turn it over to Tom Petticord, the Deputy Director for Corporate Planning and Performance Management, to take us through the details of our proposal, after which we'll be happy to answer any questions you may have. Thank you.
Okay, thanks, Brett.
Good morning. I'm going to walk us through the slide deck. Oh, is it not lit? Good morning. I'm going to walk us through the slide deck quickly, and then we will get to your questions. First, we always start by showing you an overview of the process we have followed to develop the budget. As you can see, we do a lot of work at the front end to look at the external environment, the condition of the industry. From that analysis, we do a projection of key workload indicators like number of bank failures, number of exams, number of problem banks, and we try to identify additional one-time initiatives that might be pushing the budget up temporarily. We bring all that together into a discussion with the senior management group at the front end of the process. And what we try to do is then develop budgets that are very workload-based, that reflect the workload that we foresee in the coming year. Quick overview of the budget that is proposed. As Brett said, it's a little bit more than $2.4 billion. It's up 6.5% at the bottom line from 2022. As you may remember, we have three components of the budget: ongoing operations, which is the primary portion of the budget right now, is up about 6.8%. The receivership funding budget, which is what is used to address failures and the work that ensues from the receiverships created after failures. It remains unchanged from 2022. And the OIG component, which is here for information only, is based upon the appropriations requests that the OIG submits to OMB and to the Congress. And that number is up about 2.4%. The budget, there's a relatively significant increase proposed in the budget, and it really is intended to address two key priorities. One is maintaining the workforce, recruiting, hiring, retaining the diverse and highly qualified workforce that we seek to carry out our mission. Our work is all based on people. 2/3 of our budget is salaries and compensation. And being able to have the human resources that we need to carry out the mission is critical. And then secondly, we have been in the midst of trying to update our IT infrastructure and systems to support our work. And it's the way we get our work done today, through information technology. And so there's a significant investment in continuing the IT modernization initiative. Okay, so the proposed budget increases are largely in the salaries and compensation area. Over 80% of the proposed increases in that category. And it's being driven by two factors. The primary one, accounting for about 2/3 of that increase, is the new compensation agreement that we have negotiated with the NTEU. That agreement is still being finalized, but we have an agreement in principle, and the budget reflects resources to be able to implement the first year of that agreement next year. Employee salaries will increase significantly in line with the inflation that has been present in salaries in the external environment and in our fellow regulatory agencies. I think you know we have a requirement to remain consistent with trying to maintain comparability with the other regulatory agencies, and that's what this agreement does. We believe that the agreement will help us attract the diverse and highly skilled workforce that we need, and that will enhance both our recruiting and our retention of employees. As Brett mentioned, the proposed staffing level for next year is 6,310. That's a net increase of 220 positions, and the largest portion of those increases are for new examiner positions. Almost 60% of the new positions are for examiners in both risk management and compliance. All right, I said that we try to maintain or try to present a budget that is based on workload. This was a tricky year for us. The banking industry has been resilient, more resilient than we had expected as we entered the pandemic. But there is also the sense that there are potential risks out there that could require an increase in our supervisory activities if they start to emerge. So the budget is based upon a continuation of the current environment. I want to make that clear. So the number of insured institutions and supervised institutions will continue to decline slightly. That will have an impact on the number of exams to be conducted. So both risk management and compliance exams will go down slightly from year to year, as they have been doing for many years. And the number of troubled and problem banks, while we have estimated a modest increase in the number of such banks, by historical standards, we expect that they will continue to remain low. However, as the industry has consolidated, the asset size and complexity of the banks that we supervise has grown, and we project that that will continue to grow. We wanted to highlight the fact that we are very aware of potential downside economic risks, and we expect that they may extend the average duration of some examinations. So examinations may take a little bit longer. That may also be true because it's the first time we have been back in banks for 2.5 years. We went back into banks in September, and we're just beginning that process of being on site at the banks again. Among those downside risks, interest rates and inflation are creating a lot of uncertainty. There are unrealized losses on securities in bank portfolios, longer asset maturities, and a modest decline in deposits could lead to some liquidity issues if banks are forced to actually liquidate those securities. And an increase in early delinquencies could be a warning sign that stress may occur in the commercial real estate and business loan portfolios if a recession actually occurs. So those are the supervision workload assumptions. When we move to the resolutions and receivership management business line, once again, we are projecting that the number of bank failures will remain low. We haven't had any bank failures in more than 2 years. And we will continue to work off the residual workload from the crisis. We have today about 136 active receiverships. We expect to more than halve that next year. And if there aren't new receiverships, the number of receiverships will, if there aren't new failures, the number of receiverships will continue to decline. And the level of assets in these remaining receiverships is very small and continuing to decline. So most assets that we would be overseeing would come from new failures by the end of next year. All right, when we look at the proposed budget, I want to focus first on the resources that are dedicated to the mission responsibilities of the agency. Over 90% of the 220 new positions will be in the organizations that are performing our core mission responsibilities. 170 of them, more than 3/4, are in the organizations that perform supervision functions, RMS and DCP, and they include, as I mentioned before, 127 new field examination positions. There are new attorney positions that will be located both in Washington and in the regional offices to support the supervision function. There is increased consultation, particularly in the compliance area, with attorneys as they are grappling with issues they turn up during examinations. And these are also the attorneys that have responsibility for advising on enforcement actions. And finally, there are 21 new positions that will support enhanced resolution planning in the Division of Complex Institution Supervision and Resolution. And in that case, we are intentionally trying to build out and bolster our resolution planning capabilities. We have in that division both the supervision functions and we have the potential resolution of both large banks and Title II resolutions. And we are trying to beef workload factors, primarily the growth in assets in those institutions that is driving this number up. You may recall that in the past 2 years, when we have presented budgets, the board has approved a level staffing for community bank examination staffing, but we have also approved allowing the RMS to overhire those examiners. What we have concluded this year is that some portion of those examiners that have been overhired are needed permanently within the workforce. Higher examination staffing is needed in part also to reflect the imbalance that we have today between commissioned and pre-commissioned examiners. When we have an on-the-job training or apprenticeship model for training examiners, and when we have examiners in the workforce, we need pre-commissioned examiners in the workforce. We need commissioned examiners to coach and mentor them. And as you will, as I think you know, we've developed something of an imbalance there between commissioned and pre-commissioned examiners. We normally have been having about 3 experienced examiners or commissioned examiners to 1 pre-commissioned or non-commissioned examination staff, and that has dropped to 62% today. That creates a really serious imbalance. And what it means is we have more trainees in the workforce. We need more time in those exams, both for the experienced examiners to coach and mentor, and it takes the trainees longer to perform those functions as they are learning them. So we added actually the 100 non-permanent positions you see in that authorization were added in the middle of 2022 to reflect the problem we were having with training. So we've got 100 positions in the examiner staffing authorization that reflect this imbalance and this training requirement. And I already mentioned the average duration of exams is expected to be extended somewhat, in part to make sure we are being cognizant of the potential downside economic risks that exist. In the compliance area, let's see if it's going. There we go. Oops, went too far. In the compliance area, we also have a proposed increase of 41 positions. All of those positions are directly in support of the establishment of a new complex bank supervision program that we have been piloting for about the last 1.5 years. This budget proposes to make that permanent. And what it will do, it will parallel a program we have in the Risk Management Supervision Division to focus dedicated attention on banks that are the largest in the case of RMS, but here banks that pose the greatest risk of consumer harm. And these are larger banks, but sometimes based on their product lines, they just have products that are more potentially risky in terms of consumer harm. And so what we will be doing under this complex bank program is developing individual supervisory plans for those few institutions that are in that category. And we will increase the resources that are dedicated to examining them. All right, there is an increase in funding in other areas than salaries. Travel has been a complication for us for 3 years. In 2020, as we were formulating the 2021 budget, we assumed we would soon be back to work in the new year. And so we budgeted for travel for about 2/3 of the year. We thought when we formulated the 2022 budget that we would be back into banks soon, and that didn't come to pass either. But this September, we did go back to banks, and in the fourth quarter, we've already seen travel funding tick up to more historical norms. We have a budget that is built around the pre-pandemic level of travel, inflated for the years since 2019, and the significant inflation that exists today in travel costs. So travel funding is a significant increase. It's $28 million of the proposed increase. Funding is also included for a new nationwide deposit insurance public education and awareness campaign. This coincides with our 90th anniversary next June, but also is driven in part by concern that there are a lot of products out there that are representing that they have deposit insurance coverage, and we feel a need to educate the public in that area. And then finally, a small contingency reserve is included to allow us to respond quickly in the event that economic conditions turn on us quickly. Okay, there are two significant areas of spending on major initiatives. I mentioned already that we are continuing the multi-year IT modernization program. This will become the fourth year of this, and we budgeted about $50 million this year. That increases to $60 million next year. The goal of this program, as we have been trying to really do the foundational planning for it over the past several years, is to migrate our systems to cloud environments, to move off of as much as possible the on-premise data center that we have and then the backup data center that we have to operate. We believe that our systems will be more resilient and more secure in the cloud. We also hope to expand the use of what are called low-code, no-code platforms, and those kinds of tools should reduce the costs and the time required to develop new applications. And in the course of this program, we are trying to modernize a substantial number of systems that are becoming obsolete. And then finally, by moving to the cloud, we expect that we will have enhanced data management and analytics capabilities. There's also money in the budget, $44 million, to begin a facilities modernization effort. Some of that is located on our own facilities in Washington and San Francisco, but a good portion of it is devoted to renovating our field offices in conjunction with the agreement we reached with the union on telework. So we will be downsizing, for the most part, the footprint in those offices and converting the configuration of those offices to support collaboration and to support a kind of a hybrid work environment. Over time, that will clearly generate cost savings for us from lower leasing expenses. All right, that's a quick overview of the budget with a focus on the proposed increases. This will give you the comparison of the proposed 23 budget to both the 22 budget and 22 estimated spending based upon our spending through September 30th. As you can see, we're going to underspend the budget considerably this year, primarily because of vacancies in our authorized positions and the significant reduction in travel expenses. But next year's budget goes up in part because we're restoring travel, but mostly because of the new compensation agreement. All right, and you can see a multi-year budget trend on this next slide. The red represents the receivership funding. The yellow is the OIG component of the budget. Really, the ongoing operations is the focus of the area that we actually have some control over. We call that out a little bit more here, and you can see the impact of salary inflation on this slide. Yeah. Okay, staffing also goes up, as we indicated, a total of 220 positions. 214 of those are permanent. 6 would be non-permanent. And this will give you a sense of the staffing trend. You will see that almost always we have a gap between the staffing that's authorized and the staffing that's on board. We try to account for that by a factor in our salary estimations in the budget formulation process. You can see that it closed up in 2020. That reflected the overhiring that we did of examiners in anticipation of potential economic problems. And then as that overhiring has run off, you can see we've returned to a more normal separation in that graph. Whoops. All right. Okay, you can see in this next pie charts, you can see that the budget and the ongoing operations side is all salaries. 2/3 of it is salaries, and a good portion of the rest of it is supporting the employees that we hire, the furniture and the offices and the travel and all of that. 17.2% is contracted services, which are mostly in the DOA and NIT areas. Our model for receivership funding is very different, and we always hire non-permanent staff when we build up to deal with an increase in failures, and so it's a very heavily contracted model. This shows you, we have the 3 business lines. This shows you how we break down our expenses in the proposed budget by business line. As is always true, except in the midst of a crisis, the supervision business line consumes the overwhelming portion of the budget, roughly 55% in next year. That only changes when we have a significant uptick in the number of failures. So finally, we come to our recommendations. We propose that you approve the budget that has been put forward in the case of $2.4 billion and the authorized staffing level of 6,310 positions. And we'd be happy to take your questions.
Thank you, Tom. Thank you, Brett. Thank you for that very clear presentation and walking us through it. It was really very helpful. I have a brief statement, and then I'll turn to the other members of the board. The FDIC board today is considering a proposed 2023 operating budget that represents a 6.5% increase over last year's budget. The additional resources in this budget are targeted on the workforce of the FDIC to recruit, hire, and retain the diverse pool of highly qualified people that the agency needs to carry out its mission, and also on IT investments to meet the operational and information security needs of the FDIC. The FDIC recently reached agreement in principle with the FDIC's employee union on a new 3-year compensation agreement that will increase compensation to reflect the impact that higher inflation has had on current salaries. It would also help to maintain comparability of compensation for FDIC employees relative to other federal banking agencies, consistent with the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, known as FREA. In addition, the proposed budget authorizes 220 new positions, primarily to carry out the FDIC's bank supervision and other core mission responsibilities. A number of factors are particularly impacting the need for additional safety and soundness and consumer compliance examiners, including the increasing size and complexity of the institutions that the FDIC supervises, the downside risks to the banking system in the current uncertain economic environment, the large number of retirement-eligible examiners, and the time needed to develop new commissioned examiners. And finally, the budget continues the substantial investments the FDIC has been making for a number of years to modernize and enhance the FDIC's information technology infrastructure and to protect the sensitive data that the FDIC maintains. I'd like to add that this budget also includes funding for a public information campaign on deposit insurance next year when the FDIC celebrates its 90th anniversary, particularly in light of some of the confusing claims that are being made about FDIC deposit insurance coverage of non-traditional assets. It's more important than ever that the American public understands clearly what is protected by deposit insurance. I'd like to thank the FDIC staff for the collaborative work across the agency to formulate a thoughtful and forward-looking budget and staffing proposal for 2023. This proposed budget includes resources to address the immediate challenges facing the FDIC, as well as longer-term investments for the future of the agency. I am pleased to support this proposed budget. That concludes my statement, and I'll turn now to Controller Sue.
Thanks, Acting Chairman Grunberg. So I just had a few questions, really focused on the FTE increase, and just want to confirm, drill down in a couple areas. First, you noted that the model for the FDIC is to maintain a particular ratio between commissioned and pre-commissioned examiners. Just to reemphasize, it sounds like traditionally it's 3-to-1. Is that correct?
Correct.
Okay, and more recently it's been 2-to-1. It sounds like, or something a little bit.
Well, the percentage of commissioned examiners in the workforce has dropped to 62%. It's really more like 1.6-to-1 now.
Okay.
So it's significantly down.
Okay, and so I guess from a longer term perspective, and in order to kind of get back to a place where we feel comfortable in terms of the capabilities, capacities, training, part of this is to kind of get that ratio back up.
That's correct.
Into balance. Okay. Also note that in terms of trends, longer term trends, you had a graph that showed that the authorized FTEs had decreased from 2017. It looked like that was somewhere between 5 to 10%, while at the same time, the total amount of assets overseen by the FDIC has increased considerably over that same period, and has gotten a bit more complex. The activities underneath have gotten a bit more complex as part of the FTE increase to catch up and make sure we stay on top of those, innovations, new products, et cetera. Is that right?
Correct.
Okay. And then finally, I noticed on the compliance side, there was also an increase on headcount for compliance. Is part of that to respond to some of the increased complexity of bank fintech partnerships in that particular space?
Absolutely. The establishment of the complex bank supervision program, making that permanent this year, allows us to provide enhanced supervisory oversight of the institutions that have these complex business models, including institutions that have relationships with fintechs. So the complexity of those activities can result in consumer harm, as you indicate, and we have found that we need to engage with those banks much more regularly than point-in-time examinations.
Great. Okay. One final question, and I'm not sure who this is. Maybe this guy, Harold. It's important to me that the distribution of assessments across banks of different size and complexity is fair. In particular, that community banks don't bear a disproportionate share of the burden. I know there are some limitations, and I was just wondering if someone could speak to kind of the legal authorities of the agency to address that.
I'm going to defer to the general counsel.
Okay.
Well, general counsel's back there.
No, I'm going to defer to Jim,
I'm
the
sorry,
deputy
yes,
general counsel.
Deputy General Counsel. I mean, I think to get directly to your question, we don't have the authority to provide small banks with a discount purely based on asset size. Our Section 7 of the FDIC Act makes it clear that we've got to do a risk-based pricing system, if you will. And I think others can probably speak directly to how that system is actually implemented, but we don't have the authority to ultimately give that kind of discount, if you will.
Okay. All right. So that's an area I've expressed interest in that before in various contexts. I'll probably be coming back to that in future meetings. But overall, I just really appreciate the responsiveness of staff, with the chairman, on these issues regarding the budget. And I also strongly support the proposed 2023 operating budget.
Great. Mike, thank you very much. It's helpful. Director Choate?
Thank you, everybody, for the presentation and all the information you provided. Maybe I'll just make a couple of comments and questions. I wonder, could you just share a little bit more about the field office modernization initiative? And so just sort of thinking about, when do you think the savings will, over what period of time will they accrue? What's the kind of payback period?
We're going to be doing these renovations over probably a 3-year period. 51 of them are scheduled next year. We've got 80 field offices, and most of those are going to have to be renovated as their leases expire. We project that we will recover the outlays for the renovations in a little bit less than 6 years, 5.75 years. And after that, once we've completed all the field offices, we think we will have lower leasing costs by about $6.2 million annually.
And so is that really square footage optimization and sort of format and workspaces? What's kind of the core drivers of that?
Part of this saves money just by reduction of square footage, but we're reconfiguring the offices also to support the more collaborative kinds of activities that occur in our field offices. That's where we house all our bank examiners and their supervisors. And they very much need to have collaborative teamwork kinds of activities. And so the offices are being reconfigured to support that with just touchdown kind of space for people when they come into the office.
I wonder if you could just share a little bit more. It said there would be a small reduction in compliance exams. And it's a very, very small one. I'm just curious how it's counted, to the extent to which examiners do any work on, let's say, an institution-affiliated party, a non-bank partner. Is that counted in the context of the exam of the insured entity? I'm just trying to square how the numbers are counted. And if you don't know, that's okay.
I'm going to have to get back to you on that question. I'm not sure I know the answer to that. Mark Pierce may know, if Mark Pierce is in the room.
Sure.
Yeah.
Good morning. So the numbers of exams would be our regularly scheduled exams based on the institutions that we supervise. And we would count the hours that we apply in that examination. So so the institution-affiliated party work that we might do wouldn't normally be considered in our staffing model for our estimated examination time.
I see. So essentially, it seems like the numerical piece, the hours is actually the more key piece to look at in some ways. And if we think about the smaller institutions that you do consumer compliance exams for, complexity is probably a big driver of that. And obviously, this is something that we think a lot about at the CFPB with you all, but I appreciate that. I think we should, as you think about future budgets, and how smaller institutions are growing more complex and in some ways looking like bigger ones, even though they have low assets, we may want to think about the right types of metrics to be thinking about the right benchmarks to create over time. Some of that's going to be qualitative in nature, but it's worth thinking about that as you project for the future as well.
So the compliance examiner staffing model is driven in part by the number of institutions, but it is based upon benchmarks for the various activities to be undertaken during the exam. So for example, if in the fair lending area, you concluded that it had become more complex and we needed to spend more time, that would factor in and produce a number that said we needed additional staff.
So I appreciate that. And you know, when we've talked in the past at the board about complexity and risk, I will share again that I do think our current deposit insurance assessment framework is not totally linked to some of these issues. And I think we can do better on that to make sure it's better calibrated. Clearly, there are some institutions that are much riskier and much more time consuming, and we should be revisiting, I think, that framework. And I know that our folks who work on the Deposit Insurance Fund are doing that, but I think this issue in particular underscores that. So thank you, Mr. Chairman.
Thank you. There are no other questions or comments on the budget. May I have a motion to approve the proposed 2023 annual budget?
So moved.
Thank you. And a second?
Second?
Thank you. All in favor, please say aye.
Aye.
Aye. The motion is adopted. Thank you, guys.
Thank you.
And Donna, very much. The second item on the agenda this morning is a memorandum and resolution relating to the notice of proposed rulemaking on the FDIC official sign and advertising rule and a rule relating to false advertising, misrepresentations, and misuse of the FDIC's name and logo. Luke Brown, Maren Wandwozen, Ed Hoff, Vivek Khare, and Seth Rosebrock will present the case.
Good morning. Acting Chairman Gruenberg, Acting Comptroller Sue, and Director Chopra. Today, the FDIC staff is presenting a proposal to amend Part 328 of the FDIC's regulations. This proposal is intended to ensure the official FDIC sign and misrepresentation rules keep pace with significant changes in the banking landscape, including continued evolution of bank branches and their role in serving depositors, substantially increasing reliance on internet and mobile banking channels to access banking services, and growth in financial technology companies that offer new options for accessing banking products and services. These developments in the marketplace may be beneficial, but in the eyes of some consumers, these changes can blur the lines or distinctions between IDIs and non-IDIs. In addition, the FDIC has observed misconduct in internet banking channels by entities misusing the FDIC name and logo and misrepresentations about the extent of FDIC insurance coverage. These developments may cause consumer confusion or in some cases harm if they, for example, confuse protections offered by FDIC insured products with non-deposit products that may be speculative. Today's proposal is substantially informed by feedback from the public. For example, in 2020 and 2021, the FDIC published a request for information to seek public input on potential modernization of the official sign and advertising rules. In addition, FDIC staff met with industry stakeholders to seek feedback.
Among the responses we received from commenters, they stressed the significant trust depositors place in FDIC signs, recognize the need to update rules to respond to changes in industry practices, and express the importance of enabling consumers to identify uninsured products. The proposal would modernize and clarify banks' sign requirements to reflect how consumers do business with IDIs today, including deposit taking via physical branch, digital, and mobile banking channels. It would affirm for some banks an IDI's website or mobile application effectively serves as today's digital teller window. The proposal would require signs to bring the certainty and confidence historically provided by the official FDIC sign at traditional bank branch teller windows to other varied and evolving digital channels. The proposal would also provide IDIs with new flexibilities for displaying FDIC signs. The proposal would address the risks of consumer confusion regarding deposit insurance coverage, enabling consumers to better understand when they are dealing with an IDI and when their funds are protected by FDIC insurance. It is critically important for consumers to be provided with clear, consistent, and accurate information about deposit insurance to enable them to make informed financial decisions. I'll now pass the baton to my colleagues who will talk about the rule in more detail. Edward Hoff, on my left, is a senior policy analyst at the FDIC in the Division of Depositor and Consumer Protection. And Ed will describe the requirements for the physical bank premises for IDIs. Ed?
Thank you, Luke. So for banks, the proposal includes 3 distinct signs related to deposit insurance. The first is the FDIC's official sign, which banks have displayed at their principal place of business and branches since the mid-1930s. Consistent with current regulations, all banks would be required to continuously, clearly, and conspicuously display the official sign in their principal place of business in all U.S. branches. To accommodate evolving styles and footprints of branches, the proposed rule would provide separate requirements for traditional footprint branches and non-traditional branches or other places of business, such as cafe-style branches. In traditional footprint branches, banks would generally be required to display the official sign at each teller window or station. For non-traditional footprint branches where deposits are normally received in areas of the premises other than the teller windows or stations, the proposed rule would require the display of the official sign in one or more locations in a size large enough to be legible from anywhere in those areas. The second sign requirement is to mitigate the risk of consumer confusion when a bank offers both insured deposits and non-deposit products through the same channel, such as a bank branch. In that situation, under the proposal, banks would be required to display signs continuously, clearly, and conspicuously, stating that non-deposit products are not insured by the FDIC, are not deposits, and may lose value. The requirement to display non-deposit signs would apply to bank premises, digital deposit-taking channels, and ATMs, which my colleague Maron Monmosen, who's also a senior policy analyst, will discuss next.
Thanks, Ed. Third, the proposal would modernize the FDIC sign rules to treat a bank's website or app as a digital teller window. The proposal would require banks to display a digital version of the official FDIC sign on their digital deposit-taking channels, such as online banking websites and mobile applications. This digital sign would promote a clear understanding by consumers of when they are interacting with a bank rather than with a non-bank. Bank websites and apps are now places where consumers can conduct banking business in the same manner as in a brick-and-mortar bank. When consumers log on to their bank websites or download their bank's app, they are essentially in a digital bank branch or at an online teller station. Under the proposed rule, a bank would be required to clearly, continuously, and conspicuously display a digital sign, which is an abbreviated version of the FDIC's official sign, on its homepage, landing, and login pages or screens, and on transactional pages or screens involving insured deposits. With respect to banks' digital deposit-taking channels that offer non-deposit products, IDIs would be required to display the non-deposit sign via a one-time notification when consumers initially access a web page. Such a notification would provide an initial prominent display of the non-deposit sign to alert consumers that they're dealing with non-deposit products that are not subject to FDIC insurance. Such a sign would ensure consumers continue to be reminded that as long as they remain on a page or a section of the bank website dealing with non-deposit products, those products are not FDIC insured. The FDIC is also proposing limited amendments to its official advertising statement requirements. These updates would provide banks an additional option for a shortened official advertising statement. I will now turn the presentation back to my colleague Ed, who will discuss the policies and procedures for compliance with Part 328.
Thank you, Maron. So the proposal would also require banks to establish written policies and procedures related to compliance with Part 328 that are commensurate with the nature, size, complexity, scope, and potential risk of deposit-taking activities of the bank. For example, if a bank changes its advertising strategy or engages with or expands into new physical or digital deposit-taking channels, it would take steps to ensure compliance with the proposed sign and advertising requirements. In addition, the proposal would require a bank's policies and procedures for compliance with Part 328 to include, as appropriate, provisions related to monitoring and evaluating activities of third parties that provide deposit-related services to the bank or offer the bank's deposit-related products or services to other parties. For example, a bank might establish policies related to training staff to review marketing and advertising materials to evaluate whether such materials contain misrepresentations about deposit insurance. Banks might also consider steps to mitigate risks in the event that the third party misrepresents deposit insurance. I'll now turn the presentation over to Vivek Kare, who's an attorney with FDIC Legal, to discuss Part 328, Subpart B on misrepresentations.
Thanks, Ed. Part 328 of the FDIC's regulations also contains rules on misrepresentations regarding deposit insurance coverage, false advertising, and misuse of the FDIC's name or logo, which apply to persons, including non-bank entities. When entities misuse the FDIC name or logo or make misrepresentations about FDIC insurance coverage, there's a risk of consumer confusion about whether the consumer is doing business with an IDI and whether their funds are protected by deposit insurance. To address the risk of consumer confusion, the proposal includes amendments to the misrepresentation rule that are intended to address specific scenarios staff has observed where information provided to consumers, or the lack of information, may be misleading with respect to deposit insurance coverage. Specifically, there are 4 scenarios that the proposal addresses. First, staff has observed that the official advertising statement and FDIC-associated terms and images have increasingly been used by non-banks that purport to deposit their customers' funds at a bank. Staff believes that this presents a high risk of confusing customers as to whether they are dealing with a bank and whether their funds are insured by the FDIC. To address this, the proposal would clarify circumstances under which use of the official advertising statement and FDIC terms and images by a non-bank would constitute a misrepresentation of insured status. For example, a non-bank's use of either the official FDIC sign or the proposed digital sign would be a misrepresentation if it inaccurately implies that the non-bank is insured by the FDIC and backed by the full faith and credit of the U.S. government. Second, staff has observed that non-banks that purport to deposit their customers' funds at banks sometimes make statements regarding deposit insurance coverage for those funds. Absent additional context, such statements may suggest that the FDIC's deposit insurance will protect consumers in the event of the non-bank's insolvency. The proposal provides that if a non-bank makes statements regarding deposit insurance for its customers, it would be a material omission for the non-bank to fail to clearly and conspicuously disclose that it itself it is not itself an FDIC-insured institution, and the FDIC's deposit insurance coverage only protects against the failure of an FDIC-insured depository institution. Third, staff's experience suggests that deposits and non-deposit products are increasingly being offered to consumers in ways that fail to distinguish which products are insured by the FDIC. The proposal provides that if a person makes statements regarding deposit insurance in a context that involves both deposits and non-deposits, it would be a material omission to fail to disclose that non-deposit products are not insured by the FDIC, are not deposits, and may lose value. Fourth, arrangements that rely on pass-through deposit insurance have become increasingly common, with non-banks often claiming to provide the protection of pass-through deposit insurance for customers' funds. Such representations may mislead customers and fail to apprise them of the risk they face in the event that pass-through deposit insurance requirements have not been satisfied. The proposal provides that if a person makes statements regarding pass-through deposit insurance for its customers' funds, it would be a material omission to fail to clearly and conspicuously disclose that certain conditions must be satisfied for pass-through deposit insurance coverage to apply. Finally, staff has observed a number of misrepresentations of deposit insurance coverage with respect to crypto assets, and recommends amending Part 328 to expressly provide that representations concerning crypto assets fall within the regulation's scope. Because crypto assets would be defined as a non-deposit product, the non-deposit sign requirements described previously would apply to entities offering access to both deposit products and crypto assets. Staff believes that such disclosures would help to address the potential for consumer confusion in these circumstances. I'll now hand it back over to Luke.
Thank you, Vivek. This concludes our overview of the proposal. Accordingly, FDIC staff recommends that the FDIC Board of Directors authorize publication of this NPR, which would be published for a 60-day comment period. Now, we're happy to take your questions.
Good. Well, listen, thank you very much. That was a very helpful presentation. I have a brief statement, and then I'll turn to my board colleagues. The FDIC board today is considering a proposal to update the FDIC's regulations on the use of the official FDIC sign and insured depository institution advertising statements. The proposal would also clarify the FDIC's regulations on false advertising, misrepresentation of insured status, and misuse of the FDIC's name or logo. The FDIC last made major amendments to the sign and advertising statement rules in 2006. The current rules focus on insured depository institutions' display of the official sign at teller windows or stations. The proposal before the board would revise rules to reflect how depositors do business with banks today, including through digital and mobile channels. The revisions are intended to extend the certainty and confidence provided by the FDIC official sign found at bank branch teller windows to digital channels, such as bank websites and mobile applications through which depositors are increasingly handling their banking needs. The proposed rule would continue to provide for display of the official FDIC sign at bank teller windows. This includes separate requirements for non-traditional branches such as cafes or other places of business, ensuring that the official FDIC sign is also displayed for consumers in those locations. The proposal would also provide for a new digital version of the official FDIC sign on certain insured depository institution web pages and other digital deposit-taking channels, such as banking apps. For many consumers, these channels may serve as the primary method of accessing bank products, acting essentially as a digital teller window. This makes it critical to require a digital sign indicating when a customer is interacting directly with an insured depository institution rather than a non-bank, and when their funds are insured by the FDIC. The proposal would require banks to display signage differentiating non-deposit products from insured deposits, where both types of products are offered to consumers. More specifically, insured depository institutions would be required to display signage indicating that the non-deposit products are, quote, not insured by the FDIC, are not deposits, and may lose value, close quote. This requirement would be consistent with long-standing interagency guidance that many banks already follow for physical locations and would help to make clear when a consumer's money is insured by the FDIC and when it is not. In addition, the proposed rule would provide important clarification of the FDIC's regulations on false advertising, misrepresentation of insured status, and misuse of the FDIC's name or logo. The Federal Deposit Insurance Act prohibits any person from engaging in false advertising by misusing the name or logo of the FDIC or from making knowing misrepresentations about the existence of or the extent or manner of deposit insurance. The FDIC has observed an increasing number of instances online where firms or individuals have misused the FDIC's name or logo or have made false or misleading representations about deposit insurance. For example, the FDIC has seen instances where scammers have made false or misleading assertions that their products offer the protections afforded by FDIC insurance. We have also seen circumstances where certain non-banks were making unsubstantiated claims about deposit insurance. These practices can confuse consumers about whether they are dealing with an insured institution and if they are protected by deposit insurance. Today's proposal would clarify the regulations on misrepresentations regarding deposit insurance to expressly address several of these situations, making clear when statements or omissions constitute a misrepresentation under the statute. Finally, the proposal would require insured depository institutions to establish and maintain written policies and procedures to comply with the rule. Such policies and procedures would include, as appropriate, provisions related to monitoring and evaluating the activities of third parties that provide deposit-related services to the insured depository institution or that offer the insured depository institution's deposit-related products or services to other parties. Next year, 2023, will mark the 90th anniversary of the FDIC. This timely proposal would bring the certainty, safety, and confidence historically provided by the FDIC sign and FDIC insurance to today's varied banking channels, including digital banking. I would like to thank the FDIC staff for their thoughtful work in bringing this notice of proposed rulemaking to the board today. This NPR is being issued with a 60-day comment period, and I look forward to reviewing the comments that the FDIC receives, and I am pleased to support this proposed rule. That concludes my comment, and I'll turn it over to Controller Sue.
Thank you, Acting Chairman Gruenberg. Thank you, staff, for the presentation. There should be no shortcuts to building trust, especially when it comes to safekeeping people's deposits. Recent trends and events have shown the high degree of trust that the FDIC logo instills in the public, and regulating its use as banking and finance digitalized will help protect consumers and keep companies honest. For these reasons, I strongly support the proposed NPR, and I really want to thank staff for your excellent work on this. Thank you.
Thank you, Director Chopra.
Thanks for all the work that has gone into this. I was hoping we, in May, I think, finalized the framework for the statutory authority regarding deposit insurance misrepresentation. And we discussed the uptick in cases and the emergence of the crypto ecosystem as one vector for this fraudulent claim. I wonder if you could give us an update on what we've seen and done since May.
Certainly. Thank you, Director Chopra. In May, you're correct, we did finalize our regulations implementing Section 18A4 of the FDI Act regarding misrepresentations of deposit insurance and misuse of the FDIC's name and logo. Since May, FDIC staff have been actively working to implement that regulation and to address instances where we have seen misrepresentations and misuse of our logo or misrepresentations about deposit insurance. As part of those efforts to implement the regulation, FDIC staff have established an online portal where members of the public can submit complaints or concerns about potential misrepresentations or misuse of the FDIC's name or logo. And staff have been reviewing and responding to the submissions flowing through the portal. We've received numerous submissions through that portal. In response, we have identified instances where public cease and desist letters were justified. In July, the portal went live on July 5th, and in July, we, in conjunction with the Federal Reserve Board, issued a cease and desist letter to Voyager Digital, which had been making misrepresentations about deposit insurance related to its crypto products. And then in August, we issued additional cease and desist letters to FTX, which had been making misrepresentations about its accounts, and a number of other third parties who were advertising crypto products as being FDIC insured. These included smartassets.com, CryptoSec, cryptonews.info, and another company which was claiming to be offering FDIC-insured cryptocurrency. In connection with these letters and in connection with other submissions through the portal, staff have noted many instances where non-bank entities promised that their products would be FDIC-insured, oftentimes by virtue of pass-through insurance. And as a few examples of the types of misrepresentations we've seen instances where non-bank entities made misrepresentations or failed to distinguish between insured products or products eligible for insurance or pass-through insurance and products that were not eligible for insurance or pass-through insurance. Our letters to FTX specifically addressed situations where FTX represented that their brokerage accounts, their stock brokerage accounts would be insured. Our letters to CryptoSec and CryptoInfo and some of the other smart assets all addressed instances where these entities were alleging that the cryptocurrency itself was an insured deposit. We've also seen instances where the non-bank entity made misrepresentations or failed to clarify that pass-through insurance was only available if applicable regulatory requirements were met. So these entities were saying your deposits are insured, as opposed to saying your deposits may be insured if certain regulatory requirements were met. Examples of this include the letters that we sent to Voyager. Voyager was making absolute unqualified statements about pass-through insurance. And finally, we've seen instances where non-bank entities made misrepresentations or otherwise failed to make clear that pass-through insurance would only apply in the event that the bank fails as opposed to that the third party fails. Again, a great example of this is the letter that we sent to Voyager. Voyager had said your currency will be insured even if Voyager fails as opposed to its bank partner fails. So we've observed these types of misrepresentation, and the proposed amendment to the rule clarifies that these sorts of violations would violate, or that we deem that these sorts of representations violate our rule. I will note that these amendments
Can
are.
I just interrupt real quick? That's a very important point that I think is something in the rule proposal that's very valuable. It's about how the representations are made about, in some ways, pass-through, which entity is insured or not. Sorry to interrupt, but I think we should make clear that that is something that we feel very strongly needs to be upfront to the depositor.
Absolutely. We will note that we don't believe that these amendments are required to enforce either Section 18A4 of the FDI Act or our rule against misrepresentation, but the amendments are intended to clarify, put the industry and consumers on notice of the types of information which we think is critical for the borrowing public and consumers to know when they are working with banks and non-bank entities.
Well, great. For the sake of time, I really appreciate all the briefings we received on this. I'll submit a formal statement for the record, but want to just make a couple comments now. Many of you know that disclosure regimes have long been something that financial regulators have relied on. And I think when we reflect, particularly on the Federal Reserve Board's consumer disclosures from the 70s, 80s, 90s, many of them proved to be quite ineffective. And I think one of the things I'll encourage you during this process is to really embrace the modern principles of user testing and usability, to really see with groups of consumers whether they understand it. I think separate and apart from that, let's also be mindful that a place where the consumer harm may exist is also where there's no representation made at all related to the FDIC. But there's a net impression that it may be insured or that it is otherwise safe. I think there are places in the proposed rule where you've included some language that gets to some of this, but of course the authority of the FDIC is limited here. So we will need to continue to think about how the CFPB, the state AGs, others can really be looking at some of those deposit-taking firms. Now, in fairness, the authority in the FDI Improvements Act administered by the CFPB covers depository institutions without deposit insurance, which is really not a thing anymore. So there really needs to be some thought about how do we use the prohibition on deception, other laws, to look outside of banks as well to make sure they are being upfront and honest. I will tell you, I have some particular concerns about P2P apps. You may know that there are billions of dollars each day that move on many of these apps. You know, popular ones include PayPal, Venmo, others. I think many people may not fully understand that those funds may not be insured. And I think we have to think broadly about what would happen if one of those institutions failed. What would happen? Do we have confidence that people really understand about what money they're putting in and that it's not as certain as putting it in a traditional deposit account? So as we reflect too on the recent eruptions in crypto exchanges, we need to make sure we're drawing on those lessons to think about the other places people put money outside of traditional insured institutions that may not be as safe as they think. And what's the role of disclosure and other forms of oversight to make sure that when people need their money, they can get it. So I'll pause there, but thank you so much and look forward to supporting it and seeing the comments.
Thank you, Rohit. If there are no further comments or questions from the board, may I have a motion to approve the proposed rulemakings related to FDIC advertising and misuse of the FDIC's name and logo?
So moved.
Yeah, thank you. And a second?
Second.
Thank you very much. All in favor, please say aye.
Aye.
The motion is adopted. Thank you all very much. That was very helpful.
Marty, I'm going to take a quick bio break.
We'll pause for just a moment. Okay. All right, let's resume. The third item on our open agenda this morning is a memorandum and resolution regarding amendments to the guidelines for appeals of material supervisory determinations. Sheikha Kapoor and James Watts will present the case.
Good morning, Acting Chairman Grunberg and members of the board. In this case, staff is presenting a notice that would, if approved by the board, amend the FDIC's guidelines for appeals of material supervisory determinations. As background, Section 309A of the Regal Community Development and Regulatory Improvement Act of 1994 required each of the federal banking agencies to establish an independent intra-agency appellate process to review material supervisory determinations such as examination ratings. To satisfy this requirement, the FDIC's board established the Supervision Appeals Review Committee, or SARC, and adopted guidelines for appeals of material supervisory determinations to govern the appellate process. Since first establishing the SARC in 1995, the board has periodically amended the guidelines to make changes to the process. In January 2021, the FDIC replaced the SARC with a standalone office within the FDIC known as the Office of Supervisory Appeals. Earlier this year, in May 2022, the board voted to restore the SARC structure as the final level of review of material supervisory determinations. At that time, the FDIC also requested comment on the amended guidelines, including in particular the ombudsman's role in the supervisory appeals process. In response to comments received on the May issuance, the FDIC proposed further amendments to the guidelines in October of this year and solicited public comment on those changes. In particular, the FDIC proposed to add the FDIC's ombudsman to the SARC as a non-voting member. As a non-voting member, the ombudsman would attend SARC meetings, participate in discussions, and offer views, opinions, and advice to the SARC during its deliberations, based on the ombudsman's perspective as a neutral advocate for a fair process and as a party independent of the supervisory process. The ombudsman would also have access to all materials reviewed by the SARC. To address concerns expressed by commenters about possible retaliatory actions if an IDI submits a supervisory appeal, the FDIC proposed to require the ombudsman to monitor the supervisory process following the submission of an appeal. The ombudsman would be expected to report to the board on these matters periodically. The proposal also required that all materials considered by the SARC be shared with both parties to the appeal, subject to applicable legal limitations on disclosure. The ombudsman would oversee this aspect of the process, verifying that both parties have received all materials considered by the SARC. The proposal expressly permitted institutions to request a stay of a supervisory action or determination while an appeal is pending. Under the proposal, the division director would have discretion to grant a stay and could grant a stay subject to conditions where appropriate. The FDIC received 3 comment letters in response to the October proposal, including a joint letter from 6 banking industry trade associations, a letter from a bank holding company, and a letter from a nonprofit think tank. While commenters were appreciative of some of the proposed changes, they all had further suggestions. Today, staff is recommending that the board adopt final guidelines that include all of the changes proposed in October, as well as a few additional amendments that are intended to address concerns raised in the second round of public comment. At this point, I'll turn the presentation over to James Watts to walk through the guidelines.
Thanks, Shika. The guidelines being presented for the board's consideration would add the ombudsman to the SARC as a non-voting member. This provides for a balance of perspectives to be reflected in the process while minimizing potential for conflict with the ombudsman's statutory role that could result if the ombudsman were a voting member. As a non-voting member, the ombudsman would attend SARC meetings, participate in discussions, and offer views, opinions, and advice to the SARC during its deliberations, based on the ombudsman's perspective as a neutral advocate for a fair process and as a party independent of the supervisory process. As a SARC member, the ombudsman would have access to all materials reviewed by the SARC. In addition, the guidelines would require the ombudsman to monitor the supervisory process following an IDI's submission of an appeal. This should help to alleviate concerns regarding potential retaliation. The ombudsman would be expected to report to the board on these matters periodically. Consistent with the proposal, the revised guidelines would allow a SARC member to designate any member of his or her staff within the member's area of responsibility to serve on the SARC on his or her behalf. For example, if the ombudsman is unable to serve as a SARC member with respect to a particular appeal because of information learned from meeting with the institution, he or she might designate a regional ombudsman who has not been involved in the matter to serve on the SARC instead. A commenter appreciated that the proposal would require information considered by the SARC to be shared with both parties to the appeal, subject to applicable legal limitations on disclosure. However, the commenter suggested that the FDIC clarified the timing of when parties will receive this information. The revised guidelines state that information considered by the SARC will be shared on a timely basis. This information will be provided in time for the appealing institution to prepare for a meeting with the SARC if oral presentation is requested. The guidelines provide that the ombudsman will oversee this aspect of the process. A commenter also raised concerns relating to the ability to request a stay of a supervisory determination while an appeal is pending, suggesting that the SARC decide requests for stays. In order to preserve the SARC's independent judgment based on the complete record of the appeal as provided by the appealing bank and the responsible supervisory staff, the guidelines would provide that decision-making authority regarding a request for a stay will remain with the appropriate division director. In response to comments, the guidelines would require any decision with respect to a stay to include the reasons for the decision in writing. This is also consistent with current practice. Staff also notes that if an institution is concerned about the impact of a supervisory determination, the guidelines provide for expedited review by the SARC under appropriate circumstances. Staff recommends that the board approve the guidelines for publication in the Federal Register. The revised guidelines would take effect immediately upon the board's approval in order to provide the benefits of these amendments to institutions as soon as possible. This concludes our presentation on the guidelines, and we'd be happy to answer any questions you have.
Thank you very much. That was very helpful. I have a brief statement, and then I'll turn to the other members of the board. Today, the FDIC Board is considering amendments to the guidelines for appeals of material supervisory determinations, under which banks are able to appeal certain supervisory decisions to the Supervision Appeals Review Committee, a board-level standing committee. In October, the FDIC Board proposed changes to the guidelines in response to comments received on the board's May action to restore the Supervision Appeals Review Committee as the final level of review with a request for comment. The changes proposed in October included expanding the role of the FDIC's ombudsman in the appellate process, improving transparency in the process by sharing materials provided to the committee with the appealing bank, and expressly providing for banks to request a stay of the supervisory determination pending appeal. More specifically, the guidelines would add the ombudsman to the SARC as a non-voting member. In addition, the ombudsman would monitor the supervisory process following an appeal, which may alleviate some institutions' concerns regarding potential retaliation. The guidelines also would improve the transparency of the appeals process by requiring that information considered by the SARC be shared with both parties to the appeal on a timely basis, subject to applicable legal limitations on disclosure. And finally, the guidelines would give the division directors for risk management supervision and consumer protection discretion to grant a stay of a supervisory determination while an appeal is pending. In response to comments, the guidelines would require any decision with respect to a stay to include the reasons for the decision in writing. The guidelines being considered today include enhancements that respond to issues raised by commenters and represent an important step to improving and clarifying the FDIC's supervisory appeals process. I'd like to thank the staff for their work in bringing this notice to the board today, and I'm pleased to support this notice. That concludes my comment, and I'll turn to Controller Sue.
Yeah, I have no comments or questions. I support the proposed revisions to the guidelines. Thank you.
Great, thank you. Director Chopra?
Thanks to both of you for this. Nothing further from me.
Great. Thank you. If there are no further comments or questions, may I have a motion to approve the amendments to the Supervisory Appeals Guidelines?
So moved.
Second?
Thank you very much. All in favor, please say aye.
Aye.
The motion is adopted. Is there any new business for today's meeting? If none, that concludes the agenda for today's open session. I will now move into closed session. Thank you very much.